Hello, and welcome to this lecture on internal control as part of our financial accounting series. So, let's talk about the purpose of internal control. When we think about internal control, a lot of times people just think about fraud prevention, but there's actually a number of important goals and functions of internal control. Some of the key functions of internal control include safeguarding assets, encouraging employees to follow company policies, promoting operational efficiency, and ensuring accurate and reliable accounting records. And we will talk more about each of these as we go. So, we've seen a much stronger emphasis on internal control subsequent to the Sarbanes-Oxley Act of 2002, which was signed into law as a response to some of the infamous accounting debacles of the late 2001 and early 2002, including but certainly not limited to Enron and WorldCom. I'm sure most of you have probably at least heard of one of those. Now, the Committee of Sponsoring Organizations, also known as COSO, provides thought leadership related to enterprise risk management, internal control, and fraud deterrence. In fact, their mission is to develop frameworks and guidance to help companies improve their internal controls and reduce fraud in organizations. And companies that sell stock to the general public are required by the U.S. Congress under the Sarbanes-Oxley Act to maintain a system of internal controls that adheres to the general framework provided by COSO. So the image that you see here on the screen is the COSO framework cube. You'll see that controls should cover three key areas: operations, reporting, and compliance. Controls occur at four levels: the entity level, the division level, operating unit, and functioning unit level. Now, most importantly, the framework covers five key areas: the control environment, risk assessment, control activities, information and communication, and monitoring activities. And we're going to talk more about that on the next slide. So these are the five key components of internal control under the COSO framework. So first, we have the control environment. This is commonly referred to as the tone at the top. It basically means that in order to establish a company where controls and ethical behavior are valued and promoted, it has to start at the top with executive leaders. They must set an example for others to follow and emphasize the importance of ethical behavior. Risk assessment. This involves evaluating and addressing a variety of risks, not just financial risk, but other risks such as operational risk, economic risk, and even environmental risk. This will essentially include anything that could pose a threat to the success of the organization. Control activities. This is where we see the majority of internal controls. These are the activities specifically designed to promote efficiency, prevent improper behavior, and detect fraud in the event that it's not prevented. This might include things like restricted access to cash and inventories or separation of incompatible duties. For example, the person who does the bank reconciliation should be different from the person who does the deposits. Information and communication focuses on how data and information are generated, used, and distributed throughout the organization and outside of the organization. And last but certainly not least, we have monitoring. In order for controls to be effective, it is critical that management monitors them on an ongoing basis. If the controls are not working, then management must make changes. While many control activities are going to vary from company to company, there are some standard principles and practices that we would expect to see included in every organization. Some of these include establishing responsibilities. This means documentation of who is responsible for what and who has access to what. Maintaining adequate records and documentation in every area of the business. We often call it an audit trail, but essentially we should be able to follow along with the records and documentation to determine exactly what happened, why it happened, and how it was reported in the financial records. Insuring assets. This can occur literally in the form of insurance policies, but it can also occur in a number of other methods designed to protect organizational assets. Separating incompatible duties. This is key. We often just call this segregation or separation of duties. Essentially, we don't want someone to be able to commit fraud and then cover it up. Therefore, one person should have access or control of an asset while another person has the record keeping functions. We don't want one person with both of those responsibilities. And this is similar to the next item, which is dividing responsibilities. We never want a single person with too many responsibilities in the organization, regardless of whether such duties are incompatible or not. So this goes beyond just separation of duties. We want to make sure that people are working in the areas where they are most knowledgeable and competent. In business, we often hear the term, people wearing multiple hats. We want to make sure that one person isn't wearing too many hats. We want to have people concentrated in the areas where they are best suited to be successful for the company. Applying technological controls. Technology has been a great friend to us in terms of internal controls, as many controls related to access and monitoring can be automated within the system. And then lastly, performing regular and independent reviews. Regular reviews and monitoring, that's one of the most key functions where management should really focus. The needs of the organization are going to change over time, and it's management's responsibility to ensure that controls are operating effectively on an ongoing basis and that they evolve as necessary to meet the changing needs of the organization. Now, the last thing we're going to touch on is the fraud triangle. Okay, so first, when we talk about fraud, we have to recognize first that there's two key types of fraud. First, we have misappropriation of assets fraud. This is when an employee steals or embezzles cash, inventory, or other assets. Secondly, we have financial reporting fraud. This is when management intentionally misrepresents the results of the financial statements. While misappropriation of assets is far more common, it's financial reporting fraud that generally costs the company much, much more in terms of financially, simply because the dollar amounts are much larger. While it's more common for companies to steal, or for employees to steal, they may, only be stealing fairly small dollar amounts. Whereas, if management intentionally misrepresents revenue on the financial statements, it might be to the tune of millions or even hundreds of millions of dollars. So that's kind of where we see that discrepancy in terms of dollar amounts. So let's talk about fraud, because the fraud triangle is actually, while the elements are going to be a little bit different for each type of fraud, the exact same components are necessary, okay? So the fraud triangle has three primary components. First is pressure. The employee must feel some sort of pressure to commit the fraud. Now, this can come from inside or outside the organization, okay? For example, a manager may feel pressure from their manager to report higher sales figures. So they might commit financial reporting fraud by inflating the sales revenues numbers, because maybe they fear that they're going to lose their job if they don't report higher revenue numbers. So that would be pressure inside the organization. Somebody could also experience pressure from outside of the organization. For example, maybe an employee has a gambling addiction. So they might feel pressured to embezzle money from their company to pay off their gambling debts. All right. So pressure. For fraud to occur, there has to be some sort of pressure on the employee. Next, we have opportunity. The employee has to believe that they can commit the fraud without getting caught. This typically occurs because either internal controls are lacking, or the employee finds a way to circumvent the internal controls, such as working together with another employee or an outsider. We often call that collusion. And the last piece is rationalization. The employee has to be able to rationalize their fraudulent behavior, and employees can find countless ways to do this. They might say, well, the company makes so much money that they'll never even miss this. Or maybe they think, this company's been underpaying me for years, so they basically owe me this money anyway. Fraudsters will find all sorts of ways to justify their bad behavior. Now, I'll throw something else in here as well. Interestingly, in recent years, some experts have actually added a fourth element, which would make it a fraud diamond instead of a fraud triangle. The fourth element is capacity or capability. Essentially, in addition to these other three elements, for the fraud to occur, the employee must possess the knowledge or know-how to effectively perpetrate the fraud. So that's just something interesting to think about as well. Now, from the company standpoint, we really have to focus on the opportunity piece. In reality, we have very little control for the most part over pressure and rationalization, especially outside pressures. Employees are always going to face outside pressures, and we can't really control someone's moral compass in terms of rationalization. But we have a ton of control over opportunity. We basically want our internal control systems to be sound enough that a person isn't going to be able to get away with committing fraud without it being either prevented or detected somehow in the system. So I hope that you guys enjoyed this lecture on internal controls. Thanks for watching.